Hey, and g'day everyone. My name's Ben. I'm just, can someone just pop into the chat, just make sure that the slides and audio are coming through okay? That would be great. Um, and today yeah, all good. Thank you, Blake. Yeah, perfect. Cool, guys. So today we're talking about how to build a second income investing. Look, I think investing is important if you don't want to be forced to work forever. And I think for a lot of people, it's not like they're necessarily looking to retire so that you can, go kick it on the beach. Uh, tomorrow, but creating or replacing your salary income with an investment income, it gives you freedom and options to pursue work that you want, to look after loved ones the way that you want. So today what I'm going to do is run you through the key things that you need to understand when it comes to investing so you can be smarter, and avoid some of the mistakes. And I think the reality is that there's so much noise out there when it comes to investing that it's common to fall into the trap of people thinking that there's one sort of set of steps that's going to work for everybody when it comes to investing or to your money more generally. But reality is, for every one of you guys listening in, it's the right moves really depend on you. It depends on where you're at now. It depends on what's really important to you, and how your situation is going to change over time. So today, instead of me telling you about the surefire 13 steps to become a multimillionaire, instead what I'm going to give you is some of the key things that you need to be aware of, and arm you with some of the questions that you need to ask yourself and answer to make sure that when you do invest, that you're making smart moves for you. Guys, as we're going through today as well, please feel free to pop any questions that you've got into the Q&A, and I will look to answer as many of those as I can as we go through too. So guys, look, please don't rush out and make any life-changing decisions off the back of what we cover. I strongly encourage you to seek out personalized advice before jumping in. If you're making big decisions, you should probably be thinking about doing that anyway. So I touched on at the start the fact that everyone's situation is unique, but I've found that there are three real common challenges that people face when it comes to making their investment decisions and their money more broadly. The first one that I've got up here is information overload. So it's like there's so much information, so many options. It's like almost like you're drinking from the fire hose. Hard to know who to listen to and who to trust. The second one is people struggle to really find balance between how do you get ahead with money at the rate that you want, but while you're also living the lifestyle that you want. And then the third is the FOMO, or like the fear of missing out, and some of the psychology that sits around where we invest, but probably almost more so than that is the fear of making a mistake or fear of doing something dumb that's going to cost you a bunch of money. And what I found is that it ends up leading people to get stuck, and it's stuck, not always stuck doing nothing, but stuck often doing the same thing that you've been doing in the past and missing the opportunity to be getting your money working harder for you and getting more out of what you have now. So today we're focused more in on the investments itself, but I've found that there are these three different areas of your money that you need to get right if you want to achieve any level of real success, which is your structure, strategy, and solution. So your structure is all about making it easy to save and manage your money on a day-to-day basis, but making it really clear how much money you've got to work with when it comes to investing or paying down debt or saving or building your emergency fund or whatever. That ties in with the next element, which is your strategy. And that's all about really understanding the different pathways that are in front of you that can take you from where you guys are right now to the ideal position that you want to be in with your money. So it might be that, buying shares or ETFs or managed funds or whatever, or buying property. How do you do that? Essentially being clear on what those pathways look like so that you can choose the one that gives you the best balance between getting ahead with your money at the rate that you want and, making sure that you can live the life that you want on the way. And then really for the last element of strategy is breaking it all down into a really clear action plan where you know exactly what your next steps are, and what's coming up. The third element here is the investments and the product solutions that you use to back up your strategy. So here you want to make sure that you're going to be making reliable, consistent progress over time. And importantly, that you're avoiding the chances of downsides and setbacks and those momentum killing mistakes. With investments in particular, you don't need to shoot the lights out with every investment that you make. You just need to make consistent progress, but avoid those setbacks and mistakes. I'll give you some tips on how you can do that as we go through the content today. But as I said, there are these three areas that you need to get right. If any one of the three is missing, it ends up dragging down on the others. So if you don't have a good structure in place, it's like you're working with a leaky bucket, and it's hard to know how much money you should actually be using to invest in the first place. If you don't have the right strategy in place, you're leaving money on the table, you're leaving peace of mind on the table. You're probably going to be more stressed than you need to. And if you don't have the right investments in place, you're going to end up blowing up your cash. So it's not really steps, but it is just three areas that you need to get right. And as we go through the content today, I'm going to give you a framework in each of these areas so you know what to look out for. So before I get into that, though, I just wanted to unpack the different stages that I see people go through when it comes to their money, because having spoken to a lot of people on this over a long period of time, I found that there are four distinct stages that people tend to go through with investing and their money more broadly, essentially ranging from really bad to really good. What sort of classifies what stage you're at is there are three key elements. The three things are how quickly you're getting ahead with your money, your peace of mind levels, confidence levels, and stress levels. And the third is your ability to live the lifestyle that you want. So make the personal or non-money choices that you want. So the first stage that we see people in is this distress stage. And for people in the distress stage, that's when you're essentially making no financial progress at all, or you're making really slow financial progress or no progress at all. In some cases, even going backwards. But and then from a ability to live the lifestyle that you want perspective, you're essentially trapped because you've got no money to live the lifestyle, make those personal choices that are important to you. And then from a peace of mind point of view, you're understandably pretty stressed out. I've found that you can't actually get out of this distress stage without making a commitment to your money, because money is one of these things that it is really important, but it's also never really urgent. So it's easy for it to let it slip to the back burner, some tomorrow that just never comes around. In order to get the results that you want, you need to take action. But to make that happen, you need to make that commitment. The next stage that I see people go into is a stalled stage. And that's where people are making some progress getting ahead with their money, but it's slow and slower than they would ideally like it to be. From a peace of mind point of view, they're not fully stressed out, but they do just have that niggling thought in the back of their mind that there's something more that they should be doing or something that they must be missing out on. And from a personal or like lifestyle point of view, that you're able to make some of the personal or lifestyle choices that you want, but it often comes at the sacrifice of getting ahead financially at the rate that you want. The next stage that I see people in is this comfortable stage. And for people in the comfortable stage, that's when you're now starting to build some really solid momentum from a financial perspective, as well as building a real confidence from a peace of mind point of view, and finding a good balance between getting ahead with your money and living the life that you want. And then the fourth stage is what I very technically labeled the killing it stage. And for people in this stage, it's where you're getting really rapid acceleration from a financial perspective, no limits on the personal lifestyle choices that you can make, and from a peace of mind point of view, feeling completely carefree. So look, guys, it is a progression, and there are some key things to do to get through those stages. The first is making that commitment, as I mentioned. To get from the stalled to the comfortable stage, it's about taking action, but taking that action on an ongoing basis. So action is what drives results. So it's great to get great ideas, and I hope that you get some great ideas out of today. But we know that what's going to drive more dollars in your bank account, your investment income increasing, is you taking some action. But that action has to happen on an ongoing basis, because everything is changing so quickly these days. And COVID is a perfect example of this. Like, what's going on in the world is changing so quickly, in investment markets. What's going on with your money changes so quickly. And also what you want and what's important to you changes quite quickly. So you need to make sure that you're taking that action on an ongoing basis, so that you make sure that the action that you are taking is consistent with the world and you at that point in time. And then to put yourself in the best position possible, the key there is really to maximize every single opportunity that's available to you. So making sure that your financial situation is fully optimized, that you're doing the right thing from a tax perspective, the right things with your debt, that you're not paying more in fees than you need to, and basically squeezing every bit of juice out of your situation, because it's the power of all of those things combined that starts to drive some serious momentum with your money. So the first part that I want to unpack was around your structure, and I get, like, we're not a big fan of the B word, but having a solid budget or spending and savings plan in place is really a key driver of your investment decisions. And I'll unpack a bit about why that's so important, and then practically how you can make your life easier, or make it easier to save and invest more. When you think about allocating your money, you whether it's the savings that you've got in a bank account, or your surplus cash flow from your income, you've essentially got two choices. You can allocate that money to your spending today, or you can allocate it to your spending in the future. Your future spending is your savings and investments. So we're putting money aside today to provide for your spending in the future. Now, when it comes to this bucket, you've essentially got a few different options, which are really the same for every single person listening in today, and everybody across the world, really. You can save money in cash. You can buy shares, managed funds, ETFs. I put them all into the same bucket. You can buy crypto. You can buy a property. You can pay down debt, or you can crank your retirement, superannuation, or retirement account. It's the same 6 options, no matter who you are, and it's not rocket science what those options are. The complex part is figuring out what is the right combination of those options to get you the ideal outcomes from a financial perspective, and also from a risk and lifestyle, peace of mind perspective as well. But when it comes to looking at those 6 options, everything other than saving money in just cash in a bank account, those are the options that are going to actually grow your assets and wealth over time. So buying shares, buying crypto, buying property, cranking the retirement, these are the things that will grow. But they're also, because they're invested in investment markets, this money, that they're subject to ups and downs. So the key to making smart decisions, or getting the right results, I suppose, when you do invest this money, is making sure that when you do allocate money to investments on the future side of the ledger, that you're never forced to sell those investments at the wrong time, essentially. That assumes that you choose good investments, and I'm going to talk more about how you can make sure that you do that as we go through. But assuming that you do choose good investments, if you're never forced to sell your investments at the wrong time, or at a time that doesn't make sense, you can let your good investments do what good investments do over the right amount of time, or the long term, which is make you a bunch of money. So how do you do that? Well, the thing that you need to make sure that all of the spending that you want to do on the today side of the ledger is provided for, essentially. And there are only so many types of expenses that people have, and these are our labels. I don't want you to get too caught up on the labels, but what I've found is that most people's spending does tend to fit pretty neatly into these 4 categories, which is your fixed costs, that's your rent, bills, the boring stuff; your spending, that's your walking around money, meals, entertainment, fun money, essentially; debt, everyone's least favorite category; and then your lifestyle, which is your bigger ticket discretionary items. So think travel fund, renos for the house, new tech toys, etc. Not brunch down at the local spot with your mates, but instead it's the bigger ticket but still discretionary type items. Now, the key to having a good financial plan, and not necessarily a financial plan with a financial planner, but a good investment plan, a good money strategy for every one of you guys, is figuring out what is the right balance between these different priorities here. One priority is that you want to save money and invest money so that you can get ahead at a certain rate. The other is that you want to spend money so that you can live a lifestyle that you want. And finding what that balance is really key to getting a plan that you're happy with, that you're going to be all in to work towards. So when people invest, sometimes they just go, oh, well, I think I've got this much money, so I should be able to do that. But instead, what I've found that is that if you unpack and go, okay, well, this is what money's coming in, this money is going out, then this is what's left over. And let's stress test that and get it to a point where you know that you're saving at a rate that you're happy with, but that you're spending the money that you want on the things that are really important to you. Then you've got a solid plan in place. Now, it's great to have a great plan, but the rubber hits the road is when it starts to actually, like, day to day, make it actually happen. Because I think everybody's done a budget that hasn't worked. But what we do to make that easier is to actually run like multiple bank accounts so that you end up with the right money in the right places at the right time. So have income coming into one place and then filtering out to these different buckets. Try to automate as much of your expenses as possible. And what you end up with is an automated savings and investment system where you've spent the time, you've gone, 50,000 foot level prioritization with looking at your looking at the money that you're spending, where you're spending it, making sure that you're happy with that and happy with how much you're saving. And then you've got a system that makes it easy for that to work. When it comes to investing specifically, that should give you a ton of confidence that okay, I've got this amount of money, and I know that because all of the spending that I want to do on my today side is provided for, then I can let the investments bubble away and do what I want them to do, which is make me a bunch of money over time. So I get that budgets are boring and that it probably seems like the least sexy part of your strategy. But when it comes to investments in particular, it's one of the biggest drivers of the decisions that you should be making and how successful you'll be with the investments that you do make. So I now just wanted to unpack some of the basics and fundamentals of investing so that you can see the key things to look out for. And look, I'm going to start with the super simple stuff. So you may have seen some of this before, but then build on that to get really tactical and talk about the key investment decisions that you need to make to put a clear investment plan in place that you're prepared to go all in on, essentially. I just want to start with an example, though, talking about the power of time, and because I think that a lot of people underestimate what's possible over a longer period of time. So I've got this example where you save and then invest $1,000 every single month, starting with a $0 balance, and invest that money into the share market. So essentially, starting with $0 today, saving $1,000 a month, and then investing that money into the share market. I've used the 25-year return on the Australian share market of 8.7%. Now, we know that the past doesn't predict the future, and I was never here, this never happened, but basically for the last 100 years, the overall returns have been reasonably consistent around this level, such that my view is that I feel like this sort of level of 8.7% return should be reasonably easy enough to achieve over the next long term, looking forward. So essentially, if you had started this 10 years ago, save and invest your $1,000 a month, you would have got some dividends on your shares, which got reinvested, and then some of the shares would have increased in value. So you would have put in a total of $1,000 a month, 12 months in the year, 12,000 a year, 10 years, $120,000. That $120,000 would have grown to be worth about $190,000. Then you see, if you keep it going for 20 years, you would have put in $240,000, but the growth is starting to compound now, such that the money would be worth, the $240,000 would have grown to about $640,000. So you're almost like 3 times the amount of initial money that you put in. Keep that going for 30 years, the $360,000 that you put in would have grown to 1.7 million. So you're almost 5x now the amount of initial capital that you put in. And then 40 years, you would have put in a total of $480,000, but your investments would be worth $4.28 million. And you see that in each time period, it's like escalating with these compound returns. And you see it's quite powerful, almost 10x the returns just from being consistent, relatively small amounts over time, and getting the share market return. Now, I'm going to talk about the actual investments that deliver these sorts of returns, but as I said, that this is just investing into the share market average. So it doesn't involve you picking the next Afterpay or Google or anything else. It literally just investing in the share market and being consistent over time. So hopefully this shows the power of time. It also shows the power of getting started, because if what a lot of people do is they fall into the inaction and indecision trap, that that you need to do something, but because you're not sure what to do, then it gets all confusing and you end up doing nothing. But you see that every year that passes, you've missed the opportunity to get more of those compounding returns over time. You can only manage the risk, though, that you understand. And I think that it's the fear of risk or fear of unknown risk that stops a lot of people from investing. So I wanted to unpack the key different, I suppose, risks and how you can manage them and investment decisions to make on this journey. Now, the first thing that you need to be thinking about when you invest is a mix between defensive investments like cash and growth investments like shares. Defensive investments, you've got cash. You've also got the label that's up here is fixed interest, which is like bonds. Term deposits is the simplest analogy for this, where you lock up your money for a period of time and you get a return that's slightly better than the cash rate that you get on a bank account. But there's also a little bit more risk because your money is locked up essentially. They're called defensive investments because they're much less likely to go backwards. And they're also sometimes referred to as income investments because they're normally generating an income return as opposed to a share investment that is intended to grow in value over time. So on the growth side of the ledger, we've got property, that's residential property and commercial property. And then you've got Australian shares and then international shares. With all of those investments, that you see that the expected return on them over the medium to long term is higher than it is for the more defensive investments. But the volatility or the ups and downs of those investments is much higher because they're in the market. So you could buy a share today at a certain price point, and if there's a big share market decline tomorrow, even if your share is a really good one, it's going to suffer along with the market. So choosing the right mix between how much you invest in defensive investments and how much you invest into growth investments is one of the biggest drivers of the return that you'll get over time. Now, I think you need to be aware, though, that when you're investing into growth investments, that they do pay a higher return, but they are subject to that market investment timeline, and timeline ends up becoming all important. You see, and I've got a bit of an example here, that even good company shares, they go up and they go down, but I mentioned before that even good companies go down when the share market goes down. So if you're ever forced to sell the investments at a time when the markets are down, you end up losing the money as a result. Now, the suggested investment time frame for a share investment is 7 to 10 years or more. And the reason that they say that you should have that sort of timeline is to protect you if there is a significant share market downturn that goes on for a long period of time, that it's normally 7 to 10 years. You've got the economies and the share market cycle can recover. Now, we saw a big dip in the share market in the middle of the COVID crisis, or at the start of the COVID crisis, I suppose. And in COVID, things recovered really quickly. So it wasn't sort of a normal share market cycle. But when we saw the global financial crisis in 2008, the share market went right down by about the same amount that it did in COVID, except it stayed down for years into the future. And that's why if you're forced to sell your investments at that time, you're going to lose money. But if you bought shares a year ago, and they would now would have increased in value because the markets have done really well over the last year. If you want to sell them, you absolutely can. And so long as you're profiting, that you can exit those investments at any time. I think that a lot of people get confused because people talk about this, oh, you should have 7 to 10 years as a timeline. But if the markets are going well and you're profiting from your investments at the level that you're happy with, then you can sell them a week after you buy them, a month after you buy them, a year after you buy them, no problems at all. So understanding that investment timeline is something that is all important. And the next thing is that not all risk is made the same. And what I've got here is good versus bad risk, or essentially big company versus small company risk. If you look, there are two companies on this graph, which is one is the Commonwealth Bank. Say, for example, a big, stable, like what's called a blue chip company, where the value will go up and the value will go down, but over time you'd expect it to go up. And then I compared that with the second company being, you could consider this like a tech startup company or a small resource exploration company or something, where you see that the line is much more volatile. That for a small company, because they're not backed by a lot of assets, that share price might stay flat for a bit, and then they think that some metric comes in and they think that the company's done really well, so the share price will go up. Then if something goes wrong, it can go right down, and you get these much bigger swings and roundabouts. Now, I think both risks have their place, but when you're getting started with investing, if you're putting more of your investments into the small company, higher risk, higher potential reward investments, you end up facing more risk that your shares might underperform, or they might even blow up, and then you're having to go back to the starting line. So I speak to a lot of people when they think about investing into like shares or ETFs or whatever, and they say, oh, I think I'm pretty conservative, because they don't have a lot of experience with investing. But a lot of the times that when we unpack that, it's because that they think that a high growth investment versus a growth investment has more of this speculative investment risk, which is not necessarily the case. It just means that you've got more good quality blue chip shares and less of these small company shares that can be really volatile and really risky. Diversification is another really important thing for you to understand, which is essentially just the spreading out of risk. I've got an example here where you've got two companies. You could consider these both as like big, stable, to use the label blue chip companies, but like consider it like Commonwealth Bank and Woolworths in Australia. So, both companies, they go up and they go down. They're in slightly different industries, so that they're going to go up and down at different rates, and they're different companies. If you were to get, say, $10,000 and put half into CBA and half into Woolworths, the return that you would get on your investment is going to be averaged out, because the highs of one will be balanced by the lows of the other, and vice versa. And you see that because it's naturally like the laws of averages, that the return that you get on your portfolio now, when you've got these two companies, is smoother, because it's in the middle of the return of the two individual companies themselves. Now, that's with two companies. If you put in 10, 20, 200, 2,000 investments, then you're spreading the risk out much more, and you're reducing the return on your investments is less dependent on the return of any one stock or one company within your portfolio. So diversification is a really powerful risk management strategy, because you can essentially, the more investments you put into your portfolio, you can't reduce them. You can't eliminate the market risk. In fact, the market risk is what makes you money. But you can reduce the dependency of your return on any one particular stock. So I just wanted to talk through the share market composition overall, and then I'm going to wind that into the discussion on active versus passive investments. What I've got here is essentially the makeup of the Australian share market. So the 200 largest companies in Australia. It's like if you watch the news at night or the finance update or whatever, and they say the ASX is up by 1% or down by 1%. What they mean is the combined value of the companies that are made up in that market. Now, I've got these figures are a little bit old now, but essentially at the time that I put this together, Commonwealth Bank was the biggest company in Australia. It's since been taken over by CSL, actually, off the back of the COVID situation. But the total value of the 200 companies, the 200 biggest companies in Australia, was $1.67 trillion. Commonwealth Bank was valued at $200 billion, which meant that it equated to 8.93% of the total share market. With the other companies that are in there, we know what the value is and we know what the proportions are. Now, the reason that I'm explaining this to you is because what an index fund does, and I know that these funds are getting a lot of attention and press over the last little bit, and for very good reason, in my opinion, that what an index fund does is it just replicates the same proportions of the same proportion allocations to these companies. And it means that an ASX 200 index fund return is going to be exactly the same as what you see on the news at night when it says the ASX has gone up or down by 1% or whatever that number ends up being. With the passive, and in whether you invest passive into a passive fund or an active fund is one of the big investment choices that you do need to make, which is why I wanted to unpack it here. But with a passive fund, your investment is highly diversified because you've got a whole lot of different companies that are making it up. And also, the only way that an index fund or a passive fund can go bust is if every single company within the market goes bust at the same time, which, look, if that happens, we've probably got bigger problems that we're dealing with than just the balance of your share market portfolio, thinking like, nuclear winter or zombie apocalypse or something. By contrast, I've got an actively managed fund here. And with an actively managed fund, you've essentially got a fund manager or a research house or some sort of, could be an algorithm even, where someone's trying to perform better or differently to the market. So I've just made up some allocations here that instead of it, with an active fund, instead of just duplicating what the overall share market is doing, that someone's making a decision and saying, oh, we think that BHP is going to perform best, so we're going to put a bigger allocation to them, or ANZ or CBA or whatever. Now, I don't want to inaccurately reflect that an active fund is not necessarily as diversified as a passive fund, but most commonly they are a little bit less diversified because a passive fund tracks the entire market, whereas an active fund holds a certain amount of positions. But again, I don't want to be inaccurate with the representation, but the big thing with an active fund is that you're relying on whoever's making the decisions at the top to be able to know what is going to perform best. And the reality is that no one has a crystal ball, and we don't know what will perform best. So until after it's happened, essentially. So the stats show us that actively managed funds fail to outperform their passive alternatives in like 85 over the medium term, I think in like 85% of cases. And part of the reason is that exactly what I just said, that no one can predict the future, but also active funds are much more expensive than passive funds because they've got to put a lot of resources into the research and the teams that sit around them. Whereas passive funds, literally, it's like computer algorithm, track the market, do all the admin for those funds as well. So understanding what the difference is between those two, I think, goes a long way to helping you get started with your investment strategy. I'm going to talk about the types of investments, but I've just got a question here from Kayla. Kayla says, would more stock investments cost more in fees to sell them all at once? Yeah, that's a great question, Kayla. And I suppose it almost ties in with this next point, which is the different ways that you can access different investment options. And I might, I'll reference that as I talk through this slide, which is there's essentially four main ways that you can access share type investments. You can buy direct shares themselves, and that's where exactly like you buy a share in the Commonwealth Bank, and you own a little slice of that company. You are entitled to a little slice of the growth of that company. You're entitled to a certain share of the dividends or payout of profit of that company. Shares are the advantages of shares is that you do get to choose, like you can pick a company that you think is going to perform really well, and then you'll get right behind that company. The downside, though, and to Kayla's question, is that when you investing in shares, one, it's not that diversified, or in order to get really diversified, you have to buy like tons of different shares at the same time, which can be expensive because most of the time the buying shares comes with brokerage, and you need to pay a fee, especially if you're investing, hundreds or even in the thousands of dollars at a time. If you're paying 10 or 20 bucks to buy every single share that you're buying, that it can really, if you're buying 10 at a time or 20 at a time, it can really eat into the returns that you're, or into the cost of your investment management. An alternative is, well, there's a few different alternatives, but one of them here is managed funds. Managed funds is where you've got a managed fund provider that pulls together money from a whole bunch of investors, and then they go out and buy shares directly. What that does is it spreads out the cost, it spreads out the admin, and because they've got scale, then it can be an easier way to get very diversified very quickly and at a lower cost than having to go and buy a whole bunch of shares yourself. ETFs are very similar to managed funds, except they have a little bit, and it's probably the nuances of the differences between the two will probably beyond the scope of what I'll cover today. But essentially, ETFs give you a little bit more control from a tax perspective, which is only really relevant if you've got a six-figure plus portfolio. And even then, it's only really most relevant if you're up into the millions of dollars. But ETFs can be good, in that there are a lot of different interesting themes for ETFs out there. You guys might have seen them around the traps, that there's a lot of more and more ETFs coming out, which do have interesting themes behind them: cybersecurity, cryptocurrency, healthcare, a whole bunch of different things. So can give you access to a different range of investments, which can be good. The fourth one that I've got here is micro investing. And for micro investing apps, that's companies like your Raise, Stake, Goodman, Stocklight, where you're essentially fractionally investing into, could be shares or managed funds or ETFs or exchange traded funds, where with a micro investing app, you can normally get started with as little as like $5 or thereabouts, and then just invest very small amounts over time with reasonably low fees. So each of the different investment types here, they have their advantages and disadvantages. But I think ultimately one of the big drivers of what's going to be best for you goes into your investment strategy itself. So what sort of investments do you want to be following? And then how much are you putting in, essentially? Because if you know that you want to follow say a passive investment strategy, then you say, okay, well, how do we access that? We know that shares are knocked out because buying direct shares are going to be too difficult to replicate at the whole market yourself. Managed funds, yes, you can access passive managed funds. ETFs, yes, you can manage passive ETFs. Micro investing, yes, you can. So it starts to narrow down the field. And then if you say, well, I'm investing a certain amount of money, then it might mean that if you're just getting started, maybe micro investing makes the most sense because your fees are lower. Or if you're on a path where you're going to get to a substantial balance, in a reasonable time, then you might say, okay, well, maybe managed funds or ETFs might be better. So that's how you look at the differences between them, and assess, but I'd take a strategy first approach there. A couple of other questions. What apps or funds are good for getting started investing? So look, I think sort of what we've just covered there, I've mentioned the micro investing apps, Raise, Stake, Spotlight, Perla, Stocklight rather. There's a bunch out there. I'm sure if you do a bit of Googling on which funds are there, which micro investing apps are out there, then you'll find a bunch. Micro investing apps I like because they generally have a pretty slick user experience, whereas the other more traditional channels, they tend to not. Although there has been more and more investment and more companies coming into the space of like a company like Self Wealth, for example, where they do have a really slick user experience, easy to open the account, easy to access digital, and all of those sorts of things. So so it's good to see those developments coming in. I do have this in a future slide, but you should be aware that, like in Australia, if you if the investment platform or app that you're considering using has a product disclosure statement and a financial services guide, it means that you're protected under your money is protected under APRA, which is the Australian Prudential Regulatory Authority, which means that it doesn't matter if you use CommSec or SelfWealth or E-Trade or whatever. If any of those companies go bust, your money is still protected and safe because of the nature of the controls that the regulator insists that these companies have in place. So you don't really need to worry so much about the risk with the overall like platform or the wrapper that your investment goes in. It's just the actual investments themselves. Taryn says, do you get taxed on your shares? So yes, unfortunately, the answer to that one is yes. If you're receiving dividend income on your shares, then that gets added to your taxable income, and you pay tax at your marginal rate. Similarly, if you're realizing capital gains on your share investment, so if you buy a share for $10 today and you sell it for $50 in the future, that the uplift is a capital gain, and you do need to pay tax on that capital gain as well. Sorry about that, Taryn. Hannah says, what are your thoughts on LICs or listed investment companies as an investment option for someone who knows little about share investing, has little time to spend learning, and wants instant diversification? Look, I suppose it's a bit of a preference thing. I think listed investment companies used to be really, really popular back in the day. And I know that a lot of like parents and grandparents' generation, they were like right into listed investment companies. There are a few risks with those sorts of investments around, the management and net tangible asset value backing and these sorts of stuff that we've seen create a bit of headache for listed investment companies in the past. I would say that at the time that these companies really got quite popular, that they didn't really have access to exchange traded funds and managed funds in the way that we do today. So again, it's a matter of personal opinion, but my opinion is that they're probably ETFs or managed funds would be an easier, better option with a little bit less risk. But there's nothing wrong with listed investment companies. And I think if you understand the ins and outs of them, then that's fine as well. So sorry, I know that that's not super definitive, but yeah, I hope that helps, Hannah. Matilda says, has been an excellent presentation. Thank you. You're welcome, Matilda. I have a couple of practical questions. Is there a minimum investment amount to get started? So I'll just answer these in turn. Is there a minimum investment amount to get started? Well, yes, most of the time there is. With micro investing apps, though, that's as low as, say, something like $5. So it's pretty low. Can you regularly add to that investments as you discussed, like in the talk? Yes, you can. With using a managed fund or a micro investing app, you can invest literally any amount so long as it's above the minimum, which I think for managed funds, I'm not sure. It depends on the fund. For micro investing apps, it could be like $1, I think, and do that as little as daily. And yes, and then how do you find a good managed fund platform to start investing? Well, I'm going to talk about that one in a sec, Matilda, so I'm just going to park that one. Anonymous says, what would you do if you are starting? Well, I would start small, be consistent, and follow it through. I think that you pick your strategy, and I'm going to get to, I suppose, the game plan based on the last bits that I've covered here, but pick your game plan, know what you're doing, and then just violently execute, essentially. I'm just going to push on, and then I'll circle back to some more of these questions at the end. So ways to invest. You can invest through a stockbroker, fairly traditional model. You don't need to use a stockbroker, though, to pick stocks. This is the mahogany desk type crowd that give you some recommendations. Generally, that their value add is finding companies that they think will perform better and recommending those and helping you set up your investments. You can also use online brokers like CommSec, SelfWealth, etc. They allow you to buy direct shares and ETFs typically. Then micro investing apps like Raise, Perla, Stake, Goodmans, etc. You can walk into a bank, go up to the counter, and ask them to set you up with a managed fund. And that was to Matilda's question. So you can do that. I probably wouldn't suggest it though necessarily, because it ends up in a lot of cases being more expensive than it otherwise might, if you just do your research and understand online. And then you can use a financial advisor. The reason that I put this in here, though, is that you don't need to use a financial advisor in order to invest. But where a financial advisor can help is with the planning piece, and like actually figuring out what you should be in, like what is your investment strategy, what is the right platform, whether it's micro investing, ETFs, managed funds, etc. Once you know all of those things and what you want to do, then it's easy enough for you to execute on that front. But an advisor helps with shaping the strategy as opposed to just the execution, although they do the execution as well. So look, in terms of putting that into action, the practical steps, and I had a couple of questions on this before, but understand investing and then choose your strategy. Get started and be consistent. Make sure that you are smart with your tax. I know tax is a whole nother thing that I don't have the time to deep dive into today, but essentially you want to make sure that you're focused on the after-tax return from your investments. So like for couples, looking at who has the higher marginal tax rate, or do you use tax structures like trusts or companies that can cap your tax, and these things that can really reduce the amount of tax that you pay and therefore increase the after-tax return on your investments. Really, really important, and a super, super powerful part of your investing strategy. For non-business owner, like for people that don't work for themselves, essentially, the investing is the biggest area where you can save tax. So being smart at the front end is going to save you a lot of dollars at the back end. And then the last piece that I've got here is understanding where property fits in your strategy. So I'm talking about investing, shares and those sorts of investments today. But the reality is that like property tends to beat shares because of the gearing impact of property, that you use $100,000 instead of buying $100,000 of shares, you buy a $500,000 or $1 million property. So you want to understand where and when property fits with your strategy to make sure that you get the right results. Guys, I want to run through a few investing myths and mistakes. First one is that shiny brochures does not equal good returns. Or what I mean by brochures is slick marketing does not necessarily equate to good returns. There's a lot of companies out there that I've seen that do really great marketing, but there's not a lot of substance behind the scenes. So don't fall for that. Make sure that you understand what they're investing in, and make sure that it's consistent with what you want to be doing for your investments. I mentioned before that there's no real investment risk with the platform or wrapper that you use for your investments. The actual investment risk lies only with the actual underlying investments that you choose. So whether you use like CommSec, E-Trade, whatever, no risk with those companies. You don't need to shoot the lights out with every investment that you make. Like I touched on at the start, that compounding example over time, that you don't need to you don't need to pick the next Afterpay or Google to get great results. You just need to be consistent and follow it through. And you don't need an advisor to invest. I touched on that before. Investment mistakes. The first big one that I see is making choices in isolation. Probably the most common question I get asked as a financial advisor is to say, if I got $10,000, what should I do with it? The reality is that any investment needs to fit in with your bigger picture. So like your property strategy, your career strategy, the other things that are going on with your money. So you need to look at the choices, not just is this a good investment, but is this a good investment for me? Seeking the best option is another thing that people get so caught up. I see normally engineers crunching dividend yields in spreadsheets and growth curves and all of these things, but they end up, no one knows what the best option is until after it's already happened. So if you get too caught up trying to figure out the best thing, that you're going to get stuck and end up not actually getting not taking any action and not getting results. Settling for something that's good and getting results now is going to be much more powerful than waiting for this best thing that we never know until after the fact. Unfortunately, no such thing as a set and forget money strategy these days. I touched on that before. And going it alone, like there's so much stuff going on with our money that it's its own specialty, and it's almost impossible to do all of it on your own, especially when it comes to investing. That we've got a lot of psychological biases and flaws that stop us from making smart investment decisions. So when you're trying to figure it out, you don't have someone to support you with your decision making around investments. You fall into that psychology. You end up not taking advantage of opportunities when you should. You don't have the confidence to be aggressive from investing when you should as well. And what a practical example of this is like in the COVID crisis, that we saw the share market go down, and for a lot of our clients that were sitting on decent piles of cash, we said, now's the time, let's go hard. And everyone was really fearful, but most of them listened to us and pushed their money in at the time that ended up being great. And they ended up getting the results. Whereas when a lot of people were so scared when all of that noise was out there, that they just couldn't push themselves to do that. And that's obviously a bit of a one-off, but one-off sort of situation. But there's a whole lot of different things that happen through your life when you should be pushing a bit harder or take your foot off the pedal a bit more. And that's where having some good support around you can help. And then advice with an agenda, particularly when it comes to investments. There's a lot of mixed messages and noise out there, people pushing certain agendas with products and, them benefiting if you invest in a certain way or into certain things. Just be aware. It might be the best advice in the world, but just be aware of what potential conflicts exist so that you can take any advice with a grain of salt. So guys, I hope you found that helpful. I've got a bunch of questions here, which I'm going to come to in a sec. But before I do, look, I just wanted to share this one model. It talks about your progression from where you are today to this point in the future, sort of ties in with that money stages model that I mentioned before. And I think a lot of people think when they think about getting from where they are to where they want to be, that they think of their progression like a straight line. But because of the compounding impacts of time and money, it's actually a curve. If you're not 100% on track to end up in the ideal position that you want to be in, you need to actually do some stuff and jump the line. And once you do that, taking the next step becomes easier and easier and easier. But the longer you leave it, the bigger the jump becomes, the more and more difficult it is to jump the line, and putting yourself in the best position can become impossible. So the sooner you take action, the easier it is and the less that you need to sacrifice to make it happen. And I'll leave you with this quote from Derek Sivers. It talks about, if information was the answer, we'd all be billionaires with perfect abs. What it talks to is the power of taking action is what drives results, and focused knowledge is the key to taking action. So hopefully you guys have got a bunch of great ideas today, but the key is now in turning it into results and outcomes. So, guys, if you enjoyed that content, there's a bunch more stuff that we put out through the Pivot Wealth website, or you can check us out TikTok, Instagram. I've got a podcast, How to Be Successful with Money. And look, obviously, this sort of stuff is exactly what we help people with as well. So if you did want a bit of a push in the right direction, we do this 10-minute, no-cost investing focus chat where it's like, talk through where you're at, what are the opportunities, give you a bit of no BS Q&A, and understand your next steps and what you can do. If we think we can help, we can talk about how. If we don't think we can point you in the right direction. And we know that sometimes people just need a push to take their next step. So I've just popped the link for that into the chat. If anyone's keen to have a chat, feel free to. You can book in a time directly through our calendar there as well. And yeah, happy to help. So I'm just going to jump into these questions. Rosie says, what category does ESG fall into? Rosie, I think you correct me if I'm wrong here, but when you're talking about categories, active, passive, or the ETFs, managed funds, micro investing, the answer is that it can fall into all of them. So you can have an ESG, like a ethical passive fund. You can have an ethical active fund. You can have an ethical ETF, an ethical micro investing solution, an ethical share portfolio, essentially. So it can be across all of them. Hope that one helps. Ellie says, "Or can you explain renounceable rights offers?" I don't think I can, Ellie, but it's probably a bit more than I have the time to get into in that one. Sorry. Andrew says, "What is your take on Robinhood online services?" Look, I think any online tech solution that, sorry, Ellie, thanks for that. I think any tech solution that gives you access to good quality investments at a reasonable cost that has a user experience that you connect with can be good, as long as it's got a financial services guide and a product disclosure statement. Then I think you're well placed. And the reality is that you've just got to find something that you're comfortable with and ready to get behind. There's not a lot of difference between a ComSec and an E-Trade and a Self-Wealth. It's like what floats your boat in terms of user experience, and then it's literally just a matter of picking one and then starting to just build some momentum. Mayo says, "What are your thoughts on self-managed super funds?" Look, I think self-managed super funds can be great, although you generally, when you don't have more than, say, $200,000 in your superannuation, the cost of them can be prohibitive. And also, if you're doing anything other than borrowing to buy property, then you can probably get a significantly cheaper option somewhere else. You can essentially self-manage your super without not using a self-managed super fund, but using like Australian Super that have a direct share trading platform. So I would say, like, why are you doing it and what do you want to invest in? And then what other options are there for you to get that? Guys, I got a bunch of questions here, and apologies, I won't have time to get to them all, but anyone can hit us up through the Pivot Wealth website if there was anything that we didn't get to at www.pivotwealth.com.au. One last question I'll answer before we wrap up, which is any thoughts on investing in crypto? Look, I think it has its place. So I think the place is part of a portfolio that is stocked with good quality investments. But yeah, where people go wrong with crypto is going right into ICOs and super speculative, high risk, high reward investments too early. Guys, I hope you've enjoyed that. We've got a bunch of content coming up with GA, so please check that out and what the guys are doing. They're up to some great stuff for GA as well. I will catch you next time.